welcome to another edition of the Fat Tail Investment Podcast. I'm Callum Newman, and I'm thrilled today to have on a resource fund manager, Hedley Widdup, who's going to tell us about his mining clock and what that indicates for timing entries and exits into mining stocks on the ASX. Now, before we get to Hedley, let me give you a little bit of background on an important conference I went to. So back in 2017, I flew up to a conference in Queensland. It was called the Resource Rising Stars Conference. And it was 2 days of companies presenting. And it was really interesting to me because you could get a feel for the people around the companies and which ones were a little bit obscure or maybe a little bit lacking in energy, and some of the ones that were like, oh, I'm a bit more interested than I was before, then compared to when you just hear about them or read their announcements or whatever. Now, interestingly for me there, I was in the lift going down and I met a guy. I didn't know his name then, but I met one of the directors of a company that was going to present, and his name turned out to be Tim Goyder. And at the time, he had a little resource exploration company that had a couple of gold projects, one in Victoria, one in Canada, and a couple of other projects around Australia. Fast forward about a year, even a bit longer, I ended up recommending that stock in December 2018. And then fast forward from that again to March 2020, that stock went on to hit one of the biggest resource discoveries in Australia in the last 20 years. Not only that, Tim Goyder also has a lithium stock that's gone from, say, 2 cents to about $1.80 in the last 18 months. So I would say since that conference, Tim Goyder's net worth has gone from, 20 million to almost $1 billion or something. Absolutely incredible story from his perspective. But the reason for the podcast today is that I also saw a guy called Hedley Widdup present at that conference. Now, Hedley runs his own fund that purely invests in resource exploration stocks. At the time, he showed up on the screen a clock that he used that came from his dad. I think he tells us later. That at the time, you got to remember this is 2017, was down towards the market had been in distress, and he was like, "Well, this is a very good time to get in a general sense, timing wise, as we come out of this downturn into the next upswing." Now, lo and behold, the years pass and get busy with other things. I kind of forgot about his clock. And it was only, I just happened to glance at the computer the other day and I saw it pop up. I was like, I remember that. And the clock is pushing towards the danger zone. So immediately I was like, I've got to get a hold of Hedley Widdup to see what he says about resource stocks today. So that's what we've done. Now, as I said, that conference was really, really good fun. In fact, Belvedere, show that bit of footage that we've got from the conference. They'll probably enjoy that.
You're one of the most beautiful girls I've ever seen.
Thank you, but I think my mouth is too big.
No, it's the right size. For me, that is.
It really was a wonderful time. And I did a lot of work on that weekend. And as I alluded to earlier, it led to some great investments. So now we move on, and it's time to hear from Hedley Widdup, and he's going to tell us about gold, about the exploration sector, where he sees opportunity and danger. I hope you enjoy it. Here's Hedley. We're going to start with the clock. So by way of background, 2017, I'm sitting in Resource Rising Stars Conference. I remember you putting the clock up there, and I'm like, I've never seen the resource cycle described in that way before, even though years ago I read, Jim Rogers' Hot Commodities, and he always did. And the theory you've always got to buy when things are in distress and all that, which sounds great in theory, but it's always a little bit more difficult. Then I happened to see a tweet from a recent presentation that you did showing the clock moving up. So just for the people that don't know you or don't follow resources quickly, can you tell us a little bit about the clock and your view of where it might be now?
Yep. So the clock is a concept which probably originates 30 or so years ago out of a stockbroker called JB Weir. It was originated by a person called Robin Widdup, who's my father, and I work with him now. So we've sort of carried this concept through. And it was developed really just as a cartoon to show how the resource cycle sector moves from boom to bust, bust to boom, and around and around. And the thing which makes the clock analogy so appealing is that it has, I suppose you'd say, a sequence of characteristics that you can see in the market each time around, which are reasonably recognizable, and they betray liquidity coming into the market. Now, you can compare times in the market by just comparing prices, and you can say, well, here's the low, were the prices the same? And maybe they were. I think that would probably be coincidental if they were. And then, same at the peaks. Does the market moving past a previous peak indicate that you've reached the end of a cycle? No, not at all. Typically, peak upon peak upon peak is going to be higher and higher and higher. So comparing shapes can be misleading, but comparing behaviours that drive the market to new peaks each time is the basis of the analysis, which gives you that. So, for example, we align the very start of the bust, the crash, at midnight. So clock strikes 12. Cinderella's coach turns back into a pumpkin, and all the investors turn back into, well, I suppose they turn back into mice, don't they, and run away. And liquidity leaves the mining sector. Now, it's not money abandoning it completely. There's never been a cycle, particularly in recent history, where BHP has been completely sold out and gone out of business. Companies like BHP and Rio still have strong cash flows through those times. But you can see that they go through deleveraging and they need to try and pare back their costs and things like that. At the very bottom end of the sector, where you have the explorers, their funding gets cut off because they have no cash flow. They raise their money in the market, and investors stop investing in fresh placements and IPOs and things like that in order for them to explore. As time goes on, there's a healing process. Investors come sneaking back, and probably the first indication that the market is reopening, if you like, as far as the explorers go, is that you can start to see a tick up or even a recommencement of IPOs of exploration companies onto the market. Now, there's two big markets in the world. It's the ASX, which is where we live, Callum. So we see ASX every day. And then in Canada, there's a two-tiered exchange. In fact, there's more than that, but the two tiers are the key ones, TSX and the TSXV. So when you start to see new exploration IPOs coming onto TSXV and ASX, it shows you that you've hit 6. So we position that at the other side of the clock from the bust, and that defines when the boom commences. Now, there's a lot of people who stop me at conferences and say, mate, the boom doesn't start then. And they don't stop me to talk about 3 o'clock. They don't stop me to say, hey, this is happening. Do you think it's still 3 or is it 4? They don't give a stuff. And most of the time, they're not even at the conference to stop me at 3 or 4 o'clock. But at 6, at 6 is when people just start to have a glimmer of disagreement. So that's the other sort of marker for me is, first of all, you're seeing liquidity sneaking back into the small end of the market. But in the social pages, you're starting to get people saying, no, it's not 6, mate. It's been 6 for ages, or it's 9, or it's this. And then that tempo of disagreement actually creeps up as you sneak around. So, and from IPOs starting, you start to see things like exploration expenditure creeping up. And you can track that for jurisdictions like Australia. You can track that through the ABS. I think the catalogue number might be, I'm going to get this wrong. Is it 8412? Anyway, if you go to the Australian Bureau of Statistics website, you can Google, you can search for mineral exploration, and you can download the statistics for decades. So you can see the cycles apparent in how much money is spent, and you can even see meters drilled and money spent, so that you can work out, whether it's actually just an inflationary thing or whether there's actually an activity measure going up. But exploration starts to tick up. So you go through 7 o'clock as that happens. And as you sort of sweep through 9 and 10, you start to see things where the junior sector has been so successful that you get people who have dependable salaries in big companies moving in and starting their own, brand new career as an MD or a CEO for the first time in a junior company, heading up an IPO. And you start to see really quite large deals taking place. And, they become more hostile. You might see premiums sneaking in as well. And then By the time you get to 11, the one thing which can happen at 11, which cannot happen at any other time, is very, very large IPOs of mining companies. So by that, I mean $100 million or more raised. And that shows you that liquidity is probably at the highest.
Just to bring it to the reality of the market. So I'm thinking of, what was that copper company? Is it 29 Metals that came to the market last year? Something like that, where those guys put together the copper assets because they could see people wanted. In fact, they just said, like, investors want exposure to copper. We'll give it to you.
Yeah. Yep. And it's been a really successful IPO, that one, right? So it's gone up since, which is a measure of a good IPO. If you go down in price afterwards, it means you've conducted the deal wrong. If it goes up afterwards, you've probably conducted it wrong too. But you've got to remember that pricing an IPO is not an exercise in keeping it constant straight afterwards. For it to be a success, everyone needs to feel that. So 29 Metals raised, I think, at $2 or something like that, and it didn't take them long to get to sort of 230, 240. Everybody's happy about that, and they picked the copper market well.
So just to relate it back to when so you're getting this rising interest with investors. Do you think there needs to be, as part of this sequence, a narrative like today we have electric cars, battery metals? There's going to be some overarching narrative that pushes people along with it.
Yeah, definitely. So liquidity is totally motivated by a theme, and that is probably the thing that varies most from cycle to cycle. Is what is the theme that's driving it? And this is one of the things which people love to disagree with me on, and I love to have this disagreement because it shows that people are thinking about it, and they don't think about it unless you're in that part of the cycle where they do. So in 2000 and let's say 4, 5, 6 through 7 and 8, it was iron ore in China. And people would say to me, although I hadn't moved into this business then, but I'd have conversations with them in say 9 and 10, and they'd say, "No, the clock was wrong. Iron ore was at 10, 11. Everything else was at 6." And it doesn't matter. It doesn't matter if it's iron ore or if it's gold or if it's anything else. If it's pulling money in and driving IPOs, exploration, larger and larger M&A, proliferation of smaller companies which turn into larger companies, that is the definition of liquidity. And it's not defined by what drives it. If it pulls it into the mining sector, that's good enough for me to say it's driving the clock. So this time around, you can definitely say that, we went into 6 o'clock in very, very early 2016. And the driver at that point, I'm almost certain, was gold. The first 6 months of 2016 saw a huge rise in the price of gold. I can't remember what the percentage performance was, but it was eye-watering. It went up quickly, and that provoked a lot of money very quickly to come into the small end of the market. Never really happened before, so we went from 6 to 7 to 8, I think, or thereabouts, very, very quickly. Gold then sort of tempered, and it wasn't long after that lithium, and lithium had been having little spikes here and there, but lithium kind of became a fledgling proper commodity market circa 2017 as you started to get some serious money raised to build some new projects. And lithium had a spike, it came back down, but that was another pulse of liquidity. So I think that probably saw the market move towards, I think it was roughly 9 o'clock by the time that lithium wave had washed through. And it was two different commodity baskets which had done it right. But then we sit here now, and my assessment is that the mining sector is at 11 o'clock. And we should probably come back to that because I need to caveat it by it doesn't mean it's about to crash. But
can I throw one more commodity? In 2019, we had Brazil go down, and that juiced up the iron ore market as well. So it really has been a bonanza in so many ways. And I remember, this is funny actually, because in August 2020, there was a headline about gold going bananas on the Financial Times. And I remember I said to my guys, gold has been running now for so long. Like, it really had from 2018, they'd gone up so much. And I'm like, it's always brightest at the top kind of thing. I'm like, I'm a bit wary of gold, and they've just gone down ever since. So that's what you're sort of watching for, isn't it? You're like, you've got to look backwards as well as forwards and go, this has been running, like, how many's left to get in now?
You do, absolutely, yeah. And I mean, there's a good fundamental view of a lot of commodities which will play out. But I think your feeling that you were talking about in gold there was probably more a gold specific one rather than a mining sector specific one. But you're right. I mean, the juicing of iron ore by the sort of collapse of Brazil for a period of time definitely had an effect, although the difference between sort of circa 2017, 18 and 2005-6, if you like, just to compare, like and like. At one point, there was a lot of interest in the iron ore market, and there are a lot of junior companies listing, picking up ground, trying to be the next iron ore miner. And there's been one, if we're really honest, that grew out of that and has been a stayer, and that's Fortescue. There's been a couple of smaller ones, and there are companies that produce iron ore, but very few of those were born singularly from that price movement. Quite a few of them are on their way already, or have sort of fizzled into not much. This time around, there's been very few juniors in iron ore, and I think that's because the realization was that if you want to mine iron ore in any jurisdiction, sooner or later you're going to need access to a train set and a port, and if you don't have those things, then your costs are going to be extremely high, and probably above the point where iron ore will sink to in the base of its cycle. So you'll be out of business at some stage. So it becomes a shorter term game for them. But here we are at 11, and the flavour of the month is definitely battery metals or battery materials, and that is undoubtedly driving a lot of liquidity. It's starting to drive M&A, and we've seen some of the bigger market metals like copper and gold move into quite an advanced stage, I think, of M&A and deal making, which and by the time you combine that with the IPO behaviour, it seems like it's quite a mature market from the point of view of money in it.
So when you're looking, I noticed that Goldman Sachs came out the other day and said, oh, look, there's a shortage of everything. And I'm seeing headlines about Australia going into another mining boom and super cycle. In one sense, those are classic signs of a top, right? Like when there's all this positive news coming out and everybody feels good about it. Is that part of the danger signs that you're sort of seeing?
Just seeing them doesn't flash danger to me. But you've got to remember that at the peak of the last boom, the headlines were fairly similar. But in saying that, you can have 2 or 3 years of those headlines. I tend to think that, and I don't want to knock Goldman Sachs, when you do, or any other bank or media outlet, when you do some sort of fundamental analysis, it's very difficult to forecast a tipping point because you tend just to extrapolate, a supply and a demand going into the future. And the thing which takes demand away, which is what causes the problem for the economy, and that flows through into most other things, is not going to be foreseen. And if it is foreseen, then its effect is not going to be either. So in 2007, say, similar headlines had overlooked the risk of a global financial crisis, yet it cropped up and it caused an almighty problem. I suppose you could say now the danger signs are there in that it's not so much that those headlines exist, but that I think risks are being very clearly overlooked, and we're seeing costs within the industry start to go up very, very quickly. Now, we're seeing inflation across the entire world, but I mean, we're seeing creeping of costs in the December quarter last year, and we haven't seen the numbers for this quarter that we're in at the moment, but I suspect that if you put those 2 quarters together, you're going to see some pretty eye-watering percentage jumps in costs in miners, and that's something which takes you very close to the top as well, because it starts to rattle investors' confidence in what their money's doing, right? It's not just operating costs. If you say you're going to build something for $100 million and you commit yourself to it, and then by the time it's built, it's cost you 150 or 200 million bucks, investors go, wow, that's changed the NPV quite markedly, and it's diluted me a lot more than I thought I was going to be as well.
Well, you would have to say that's fairly acute for the lithium guys, because these are the guys that are actually building. Most of those lithium stocks are not producing yet, and they have to now confront this reality. Is that probably the tricky, because the market is priced in such a bright outlook for those businesses? Yeah.
Well, yes, I think that's a great risk for them, and it's going to be difficult for me to address this without being overly specific or by being super general, but I'm going to have to try and go down the middle because I don't want to draw attention to anyone in particular unfairly. But there have been some companies which have put together lithium mines, and they've been quite successful in sort of right place, right time, and I think probably have the internal operating discipline to take themselves through the troughs and then make the most of the ups. In any space, there is an exception, and in any space where there's been a lot of speculative money wander in or wash in this case, there's been a rush to spend it, there's been a rush to raise it, and I suspect that that's where the most potential mistakes will creep in as well. Now, when you overlay that with inflation, I think there's definitely going to be projects which are either part built and get to a point where they run out of money, or they're an exciting project but just can't fund the amount that they need, because in a fast rising inflation market like this, your expectation of the cost driven by a study or even front end engineering, which is supposed to be very, very accurate, can be here. And then, 2 weeks later, when you commit yourself to paying for something, it's crept up to here. By the time you get to install it, it's up to here. Now you'll be paying for things, but you don't pay for everything right up front. So by the time you've sort of experienced this creep, and you've purchased and taken delivery of all the parts that you need, or you've purchased something and it's sitting on a wharf, and in the time that it's sitting on the wharf, shipping rates have tripled. There's all sorts of ways that cost can creep in there, which is completely out of your control. So building a project is when you're most vulnerable. And there are, I think, as you say, there are a lot of lithium projects which are at that stage, and they're going to be tapping the same pot of money. So there's a risk of that running out. Now, I don't think that could necessarily bring a top to the mining market, but that is certainly going to put a lot of doubt in investors' minds. So it puts a lot of pressure on the lithium price to keep going up.
How do you cope with this as a fund manager? Because my understanding is you invest in the junior sector. So are you hunting exploration results, or do you want to carry those businesses from the deposit to the producing mine? So
the way that we manage this as a fund manager is we try to align our investments, or the most aggressive point of our investments, when the market is cheap. And then we're happy to follow our money as we creep around through the upper parts, through the sort of 6 through to 9. And then after you get past 9 o'clock, you're starting to question yourself. You don't want to be sitting there going, we need to sell these things at any cost. You've still got time at that point. And there are things where, is it more sensible to sell a good story before a perceived crash or not? I think the answer to that is, well, if you think it's a really good story, hold it and fund it on the other side, if you don't think it's going to be existential to you. But as a fund manager, we try to front end our investments to get set in those stories and develop a large percentage position when the market is cheap. And then as the cycle goes around, we make efforts to try to be aligned with that. So rather than investing in let's say a company which is starting its feasibility study at 9 or 10 o'clock. Now, my assessment in those circumstances is that if you're starting your feasibility study, then you're going to run into the top of the boom and possibly a crash before you raise your money to build your project. And that might be a good thing, right? Because you don't want to raise your money and then the market crashes and you've got nowhere else to get it from. And you're probably facing horrid commodity prices and wondering whether you draw your debt and all sorts of other things. So we try to invest in things which have semi-defined projects in the 3 through 6 o'clock, and then take it from there. So I mean, in an ideal world, you'd have a portfolio of things that have feasibility studies being delivered at sort of 6 or 7. They still have an ability to explore, to keep the market very interested, but then they're developing a project and going into cash flow about 9 o'clock. That would be absolutely outstanding. And do you ever buy producing miners? So you're getting towards the end of the clock and you go, okay, we're just going for the cash flow here now. We tend to be very focused in our portfolio development. So, there might be 10 or 15 things in the portfolio when it's absolutely cram jam full. And we've never said, let's go out and buy a few miners just to sort of hedge some of our risks here. We've never had that kind of portfolio approach. But if we were a much larger fund and we're prepared to take many, many more positions, that might be a behaviour that we would consider. In saying that, we have owned operating positions before and certainly wouldn't rule it out in the future. But it hasn't been something that we've ever engaged in as a sort of cyclical hedge. So the lead times of mining are so long, though. I mean, you buy, just say, a gold miner in this feasibility phase at 6 o'clock. You're talking a couple of years to ride along with it. Do you have periods where you're just twiddling your thumbs going, well, I've just got to wait it out, kind of? Well, I'm a geologist who worked for almost a decade in mining geology. And I always loved geology, but the thing that I really loved about mining geology is it combines that scientific passion with problem solving. And in a mine, there's always a problem and it needs to be solved. And the time frame for it is usually 5 minutes ago rather than having any time to think about it. And you become a bit of a production junkie, or some people do. And I think that that's one frustration which I bring to funds management is that I like to be really busy, and I like to have a few problems to have in front of me that need doing now. I don't like anything which has a month to be done, because I'm probably not going to get to it for the next 28 days anyway. So yeah, we do find there's periods where you say, okay, these things are ticking along. They're the times where you probably spend more time on the ground, if you can, looking at what they're doing and really developing a great understanding of, or a far better understanding of, what the project is going to turn into, and turning your eye to the upside. And by that I mean, can this be extended? Is there an exploration story to go along with it? Or could you engage in strategic M&A to start to build a portfolio around that company, which would be useful to leverage its value as the cycle carries on.
And when you're investing, are you backing the deposit or the people, or does it have to be a combination of both?
Well, you're backing both. That's the reality. If you're an equity investor, you have to back the deposit, and you have to back the people. If you're going to hold a few 100,000 shares, less than 1%, you can be much more flexible on that. But if you're going to be holding sort of between 5 and 20%, you're indelibly wedded to both. And you can't change things like the deposit. They just have to be made to work. So technical DD is pretty important to get that decision making done right at the start. Having said that, we've never wandered off into a great deal of really sort of fancy commodity things or unusual processing or anything like that. We've tried to keep our technical risks quite low. People is one of the areas where, in our experience, that's where you get the most surprises. You can have your biggest wins as well, but it's the part which is the hardest to get right. And but you are definitely backing that, because without the right person at the front, it won't work. And
previous to that, do you have to take a view of the commodity and go, I want to be in this commodity? Like, yeah, in 2017, you go, look, we think gold's going up, or at least in Aussie dollars, it's going up. We're happy to, because the volatility in commodity prices is so wild. I mean, you must have some moments where you go, oh, this is looking a bit dicey. Yeah, it's very difficult to make new investments or even follow-on investments when you have a pessimistic view of the underlying commodity. I mean, you've got to face it as well, that the time when the company will often come to you, particularly if it's a company which is sort of getting its sequence right and, landing the news, landing a raising, etc. They'll come to you when they're sort of, they're really on the balls of their feet and everything's going right. And that's, you're probably paying for perfection at that point in some cases. We tend not to take a really deep view of the commodity. So it doesn't drive our decision making to the extent where we say, nickel's about to pop, let's go and get into some nickel stuff. What we'd much rather do, because we have a holding period usually starting at a sort of 3 to 5 year outlook, or historically it's often been quite a bit longer than that, shorter as well in some cases. You don't want to get the commodity wrong, but at the same time, you don't want to be chasing things driven by your view on the commodity and finding yourself in very leveraged plays. So, I mean, at the moment, I've heard a lot of commentators saying nickel's going to the moon, and let's be honest, it probably is. Nickel has some fantastic years, roughly 1 in 10. Maybe that's its 1 in 10. But then commentators say, to get best exposure, go and find yourself something which is lowish grade, but it's got a lot of nickel tons in it, because it won't work at any other time in the cycle. They don't say that last sentence, but that's what they mean. You mean a marginal operation?
Yeah, marginal deposit. And they're correct. Those things will definitely have their inherent value go up by a far quicker rate than a high grade deposit. But at the same time, if the nickel price comes back down, in this specific example, you'll be trapped in something which doesn't work for most of the rest of the cycle.
And you won't be able to get out of it.
Exactly, you'll be trapped, particularly if you're a large investor. So we've tried to avoid getting into situations where we're driven by a commodity view, because it can often drive you to make the wrong technical decisions about what you want to be involved in. But in saying that, you take a perspective on the risk that the commodity itself provides. So if you and me, Callum, wanted to go out and start a little gold mine, we'd need a shovel and a pan. Well, we'd need a deposit first, but a shovel and a gold pan, and we could make gold between us pretty easily. The diggers did it. It was hard work, but and then you can sell the gold in the street. So you could walk down Collins Street. You could probably sell it somewhere between Parliament and the Docklands. You'll find someone who'll buy it off of you. Now, it's not that easy with everything else. So probably the next level up in terms of risk is copper, you can usually produce a nice clean concentrate, and for that reason, the copper market, there's known impurities, but there's a very, very liquid market for copper concentrates, of which no two are identical, but they're all very similar. And copper is reasonably easy as far as metallurgy goes. Gold, then copper is sort of entry-level stuff. You get into mixed base metals, lead, zinc, things like that. You start to experience lower payabilities. So your copper cons you might be paid for 90% of the contained metal. By the time you're in zinc, you're getting closer to 70% of the contained value. So your deposit needs to work a lot harder. It needs to be better in the ground to meet a lower threshold of payability there. And then, there are risks that come from if you want to be in the bulks, iron ore or coal. I mean, coal has its own emotional issues attached to it at the moment, but you need large logistics. So your CapEx threshold is far, far higher than it is for something like gold. So there are all these risks that creep in there from the commodity that you're exposed to, how it's extracted, how it's sold, and how it's moved to its market. And we try to avoid those technical risks.
It's very interesting just listening to that. I'm going to say, is that one reason why investors love to back gold companies? I mean, most of the exploration goes into gold. You can always sell it to investors because, like, it's the perennial gold bug thing, like it's always in demand and yada, yada, yada. And then you're saying it's the easiest to sort of get out of the ground. Is that fair to say that you then focus on gold companies?
Well, yes, it is. Historically, we've put probably more than half of our money into gold. I don't know if that's what investors understand, but I do think that's the reason why there are so many gold companies, because they are typically just easier. Whatever the threshold is in terms of development of a copper project, for example, you can lower that threshold for a gold company. And it's not, you're not talking ounces versus tons. It's just you can scale a gold project, sometimes back to something which is smaller and start earlier. Now, by the time you start doing that, you get into an argument about, are you properly capitalizing the project and all of that? There's definitely risks that creep in from trying to cut corners, but at the same time, you tend to be able to cut more corners in gold than you can in many other things, just because you need far less infrastructural support to make it work.
So you mentioned coal there. Have you guys taken a view that many did that you wouldn't invest in coal, or were you open to the idea of doing it if the right thing came along?
We're an ASX listed company at the end of the day, and we have a lot of shareholders. All funds have stakeholders, but ASX listed companies are, a little bit more visible from that perspective. We've dabbled loosely in coal over the years, and I mean over the last 30 odd years, and we've never had a great deal of success in it. And I think that's because to get the technical part of coal right, you need to have a fair bit of coal experience. Now, we're mostly metalliferous people in terms of the experience that we bring from mining. So I think we've kind of looked at coal and thought, well, I can't tell if that's really good or really bad. And for that reason, we had avoided it. Now, fast forward to now, and there is a lot of pushback from the investment market. So I think if I was to stick my hand up and say, Lion's going to invest in coal, I'd get a few phone calls from people saying, I think that's a poor decision and we're going to sell our shares, and that's on a moral ground. Now, I'm not taking a moral position on that. I have a moral position, but I don't think there's any upside from disclosing it. But I think you need to respect that. It's not my money, it's the shareholders' money. Or quite a bit of it is my money at the end of the day, because I am a shareholder and a large one. But I don't drive those decisions, and we don't drive them for shareholders. So I think things like that, it's something where there is such a fierce emotion around it. It's just easier to avoid.
Isn't this the part of the argument for coal is to say, look, nobody wants to fund it, nobody wants to touch it. If everybody's going to keep using it, it's going to send the price sky high.
Yeah, well, and that's what it did. I think, and maybe this is sort of disclosing that I've got a little bit of a scientific view here and probably a little less emotionally driven. But I think it is somewhere between ironic and outright humorous that in the year, I mean, if you had to pick one year in the last 5,000 years and call it the year of ESG, 2021 was the year of ESG. And what were the best performing commodities in that year? Oil, gas, and coal. So I think, maybe that's just anomalous, but yeah, you're right. This will result in very, very little new production in coal being funded to come to market. And in fact, if you were to look at exploration stats, there has been a lifeline cut off to people that want to explore for coal, people that want to explore for oil. Those dollars have come right down. So there will be a scarcity that creeps into the market, and that will affect the price. Now, the time it takes to find something and exploit it is quite long. So if you have a 5-year break of looking for things, that is going to be felt for decades after. So if there is not a very instantaneous move to very sustainable things and an absolute removal of the reliance on coal in places like Australia to power economies, it will be felt through higher prices. So I'm not forecasting anything there, but I think it's pretty evident the way it will take place.
It's interesting, the psychology, though, because I look at the oil juniors at the moment. We don't have a heap in Australia, but we do have some. They're all getting these huge margins. They're not moving. You look at the lithium ones who don't make any money. They've gone bananas. So it's that. So do you think there'll ever be a day, though, that you get the same rush to go? Like, does anyone really want to rush into the oil sector going, oh, oil's going, oh, I can't wait to barge in like they're doing with lithium now?
Yep.
Or does oil have to go to like $200 where you just go, this is just crazy, I've got to get on it?
Well, I think about these things in very simple ways. And I think that people as investors tend to pay far more for something that they don't understand than something that they do. And that works in reverse as well, to an extent. And I think that the level of emotion that I see towards fossil fuel companies now has pushed towards the kind of emotion that there was towards tobacco companies. Now, I haven't tracked what tobacco companies have done in terms of share price performance over the last 20 years, but I doubt that they command any sort of a premium in the market.
Actually, I looked that up actually a while back. They actually did really well. After that lawsuit in the 90s when they got taken to the cleaners, you would have thought, oh, God, that's a horrible investment. It's actually been quite a good one and paid out big dividends, whether you want to invest in that industry, though.
It probably, I mean, if you just think about tobacco as a thing, there was a point where it was like you should smoke it when you're pregnant because it's good for you and it'll calm you down. And then there's a realization that it's horrible. And then there's sort of an adjustment and an aftermath. And then you get to where we are now, which is that if you want to smoke it, you accept all the risks and it's on you. So it's like a gambling company, I suppose. Not everybody's cup of tea, but it only, I suppose you can partition it, you can justify it to yourself if you're an investor by saying it doesn't affect anyone except for the people who choose to do it. They've made a decision as an adult and off you go. I suppose coal differs from that. So this is where my example breaks down in that, the standard arguments are that this is contributing to climate change. And no one disputes that burning coal pushes carbon dioxide into the atmosphere. So I'm not trying to get into a climate change discussion here. It's more that argument applies to everybody. So you can't ignore it and say, well, it's only the grown-ups who burn coal. If it's burnt, it's going to affect everyone within a jurisdiction. So I think that that could have a slightly different effect in the aftermath there. But
we should say that it's China, it's India, these kind of countries that are using it, and we do here as well, but they're the big users. Is it fair to say it's a Western investor issue about whether we should be financing these projects to deliver it to them?
Yeah, I think that's the view that a lot of the large funds have taken. And Lion is not a fund to be considered as something which sets the tone for what commodities should be acceptable in the next 10 years or something. We're a pool of money which is a very, very small drop in that ocean by comparison. So the larger pools, the BlackRocks, etc., have been quite outspoken in their objection towards things like coal. I think actively encouraging the companies which are involved in to sell their exposures. We've seen BHP move strongly out of fossil fuels for that very reason. So I think that decision being made by those large pools of money, they're reacting to what their stakeholders are telling them en masse, I would assume. That's driven it to a point. Now, would there ever be a return from that? I tend to think it would be very difficult for those big pools of money to reverse their decisions and say, no, you as stakeholders were wrong. We're now chasing the money, because it seems to have been an ethical driven decision-making process to now. To flip that on its head, I think they would lose far too many subscribers, and they would see that as a difficult thing for them to do. But it's not to say that there aren't pools of money that wouldn't take advantage of it. There's a lot of Middle Eastern money which has been made through oil. I think they probably understand fossil fuel burning revenues better than anyone. And, that they might be some pools of money that can support coal. Economies like China and India, who are the big end users, could very well find that they're quite motivated to sponsor that as well for their own good, but also for their own profitability.
I've thought too, those
So
sort of
it's a guess.
private trading houses like, is Glencore private? I can't remember.
Glencore is now listed, but they're a trading house as much as they are a miner, yeah.
Yeah, those ones that sort of, well, private equity will finance that sort of thing while there's a dollar in it.
It's possible, yeah. I think there's probably still a bit of swirling emotional water around that for a lot of those pools of money. Glencore has mopped up some of the assets that were for sale, and they've done quite well out of them. But at the end of the day, I think for new pools of money to say let's move into this, they're going to have to test the water about what their backers feel. So I tend to feel, as you said before, it might be private money coming from one or two large sources.
Just to bring it back to the battery minerals a little bit, and the sort of the idea of a story. One thing with like nickel, lithium, copper, these all have home markets in other industries. So nickel is used in stainless steel or whatever. And then you go, hang on, 2% is going into batteries at the moment. And everybody wants to pile in because of the battery story. And then you're like, guys, you better be watching what's going on with the home market as well, because if that shits itself, nickel's going to go down. Do you think people don't appreciate the total demand of these commodities when they latch onto these kind of stories?
Yes, that's the short answer. I think it's easy to appreciate the upside of a commodity story, and it's difficult to truly understand what the dynamics are beneath the surface. So, as you say, breaking the market down into here's the traditional use and here's the new use, but that's what's going to drive all the price, is usually something which is well below, I think, most investors' sort of line of attention, if you like. But having said that, there are a lot of people who go around peddling these stories who sort of make themselves out as experts on those markets. It suits them to talk about what those markets are going to do. That doesn't necessarily mean that they understand it in a lot of depth either. The guys who are producers, and I mean, Ken Brinston at Pilbara is, I think, probably one of the best in the lithium business at seeing what's going on in the lithium space and translating it into a form which investors can understand. I think he's well across some of those risks.
You might not have seen, he just announced his retirement this morning.
I don't blame him. He's done well.
Yeah, well, yeah, he's going out the top. It could be another symbol.
Did he really retire? I hadn't seen that he'd retired, but there was an announcement this morning saying CEO succession.
But I met Ken at that conference actually in 2017. Yep. He came across as a very lovely guy. Well, and now I'll tell you who else I met at that conference: Tim Goyder, who has become the king of Australian mining. Obviously, his company, which was called Chalice at the time, hit one of the biggest discoveries in the last 20 years or something. What are the odds of you backing a company that finds that kind of elephant strike?
Pretty slim. I mean, if you just want to boil it down into quick statistics, so they've had an elephant strike. Maybe you say De Grey has had an elephant strike, although I think in terms of contained metal and just doing it on that kind of a value, the two are going to differ. But they're some of the bigger exploration discovery stories in the last couple of years. And that's out of a pool of 650 odd companies listed on ASX who could expose themselves to some level of exploration discovery. So that's pretty slim odds. To be in that position, you need to be, first of all, I mean, there's no point if you want to discover something big and unusual, going and exploring just along strike from something which is already known. You'd be looking in an area which is fairly well picked over. You're going to have a revolutionary scientific concept, which means, I suppose, your chances of being wrong are pretty high. So what Chalice had done, and De Grey, in fact, had taken maybe not new science, but a new scientific paradigm into an area. They looked over all of the data which already existed, and they put their own turn on it. I think you could probably say with hindsight that the data which did exist historically had been looked at incorrectly and been judged to be insufficiently anomalous. And these guys said, well, no, there's no reason for that, so let's go and test this ourselves. So, I think they knew that there was anomalous nickel. I might be getting this slightly wrong, so I apologise if I am, but I think they knew that there was some anomalism to be concerned about. They had a view that the rock types were going to be correct to support something, and it has turned out to be very, very large. So, they've given themselves the best possible chance of success there by taking that approach, and that probably slims their odds, but it still doesn't make it something which is really easy to pick from an investor's
And
perspective.
just to show how difficult that was, I wrote up Chalice at the time, but their focus at that time was selling their Victorian gold asset, and they had this one in Canada. They're like, these are our two we're most positive about. Oh, by the way, we got these a few other ones around Australia, and it was like wasn't even part of the narrative, if you like. And then suddenly it just like, whoa, where did that come from? It's just that's the thrill of the chase, isn't it?
Yeah, it is. Well, and specifically on the Chalice example, they sold their Canadian gold ground into what was the probably the early to mid part of the groundswell of Canada getting off of cannabis and forgetting about that as a pool of risky investment and getting back into mineral investment. Because Canada was a couple of years behind Australia in starting this boom because there was just so much money tied up in let's do medicinal cannabis. That all flooded into gold after that, and I think Chalice were beneficiaries of that. They were able to sell into that groundswell. So they found themselves a little bit cashed up. But it was probably a bit too early to sell their Victorian stuff, although it was selling well to the market as a story that they just needed to go and drill and beat up a bit before any decision could be made. And then COVID hit. And I wonder, I'm not sure I'll ever get any sort of truth on this. It might remain a cartoon forever, but I can remember sitting there with a really silly grin on my face, just thinking, geez, it took a global pandemic to go and explore 2 hours from Perth. Who would have thought you'd find something there? And you probably couldn't unless the borders weren't closed. It might not be true, but I think it's a nice part of the fairy tale.
Well, they actually released that announcement right at the bottom of the market. It was extraordinary. Somebody wrote in, I told that you were coming on the show. Have you ever studied, or do you give credence to the idea of a Kondratiev wave, like a 30-year up cycle of commodities and a 30-year down cycle? Have you ever heard of the Russian economist Kondratiev? I'm sure that you would have.
I'm going to make myself look a bit ignorant, but I'll have to tell the truth. What you're talking about rings a bell, but the name I couldn't say I recognise. Certainly can't picture a face.
You won't picture his face. He died in 1930.
No, but
something like that.
The concept of longer-term commodity cycles that overprint the shorter-term, call it mining busts and booms, I think there's a fair bit of credibility to that kind of a suggestion.
It's interesting because I used to work with a guy he was a Russian guy who was asked by Stalin to study the capitalist West, and he sort of at the time forecast, well, seems to have a lot to do with these commodity swings and all that type of thing. Anyway, it goes very deep, and some people are very passionate about it, but we won't follow that. Just somebody wrote in about it.
Well, let me give you a one-liner on that before we move on, because one thing which has driven this boom that we're in is that from we had the China boom, we had the GFC, and then everything came back. It came flooding back because of stimulus, and mining reached its absolute peak in 2011, and Glencore listed as it was the biggest ever IPO of a mining company in mid-2011. Now, the mining sector then separated from the rest of the market and plunged for 5 years. So 2011 through to 15 were absolutely shocking if you're involved in any kind of mining. And I think it was so bad because miners had just overinvested in so much shit that the bigger investors just said, you guys are idiots. We can't deal with it anymore. We're going to halve our positions. We're not just going to sort of slacken. So market weights all pushed well below cyclical low norms. I think in coming through that 5 year period, the mining industry had to stop investment that normally would have continued. Even if it was just ticking along, it stopped. And because of that, teams were lost. So you might be able to keep a development team in place for a couple of years, but for 5 you can't. They go. Your exploration team. So if these people have been together for 20 years, all of a sudden they're disbanded. You can't restart that stuff just quickly. And so we've seen this 5-year period and a very slow restart off the back of it, of investment in future sources of supply of commodities. And that is causing a squeeze now. But
let me jump in there. So BHP Rio said, well, we went way too heavy on the debt, everything. Ever since they've tried to pay it down, they're pumping out massive dividends. Their capital expenditure, as I understand it, is going down, 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 down. Do you see that as a bull factor for the next 5 years?
I see it as something which is definitely going to contribute within the next 5 years. It might not be a bull factor, because if commodity prices fall away because inflation bites the entire global economy, then we're going to have a mining crash and an equity crash at the same time. So, but in saying
that would theoretically set up the next boom, right? Because you'd have
certainly would. It certainly would. In fact, that is exactly what it would do, because you would come out of the one boom, and those big miners would be in exceptionally good health, which they weren't in 2011 or even 2015. Whereas if they go into the start of the next bust with very healthy balance sheets, you can see who the obvious consolidators are going to be. It'll be the ones that are feeling most confident from that, and they will still have strong cash flows, but they won't have to apply those to big and cumbersome debt positions. And I think this theme of the ongoing underinvestment and that will continue to pinch. It will probably mean that commodity price reactions to demand growth are going to be sharper than they would have been in, say, the 2008 through to 2011 sort of period. So I think that bodes well for the next boom. And if I'd overlay one more thing, if you think about the boom that was provoked by China, that was coming off of the back of a very, very, very long hiatus of any interest whatsoever in miners. There'd been this massive fraud in Indonesia called Briex in 1998, I think it was. That washed through the market, and it absolutely destroyed confidence in explorers, because they were just regarded as liars overnight. So all of that money that was in exploration has gone, well, what can we invest in now? We can't do exploration because they're all liars. Well, why don't we do .com stuff? That's really interesting. So, there was this .com boom. It makes absolute sense to me that one deep bust gives way to another sector's absolute bubble, the .com bubble. And it wasn't until the .com bubble popped and then absolutely washed out before you saw the signs of liquidity starting to sneak back into mining. But it gave way to the biggest boom that we've ever seen. Now, we've just had a very, very long bust and washout in mining, and we're experiencing a very different but still, tech-driven equity inflation, if you like, which is supported by a very low cost of money. So I think if you were to change a few of those settings and have money washing out of tech and wanting to find something which has a more stable future, I think the mining sector would probably be a major beneficiary of that.
Just talking about liquidity flows, we touched earlier on how gold stocks have just keep grinding down, 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 even though Aussie dollar gold is still high. Do you think that is investors taking their profits out of the gold sector and pumping it into lithium and other areas?
Yeah, there's definitely shinier things. So for the gold sector to perform equities, you need to have, I think, a longer performance in the gold price. A couple of little kicks here and there doesn't really wash a whole heap of money in. Now, that's not to say they're not good value. I think if you compare value between, say, the 2007 or even 2010 gold industries and now, you'll probably find that gold equities are far, far cheaper on a couple of metrics that you can use to compare those markets. And the explanation for that is that investors are just happy to put their money elsewhere because they feel the return will be better. So that combines outlook for gold price with outlook for everything else within the commodity space.
I just wanted to touch on China a little bit. Obviously, they're the big demand. We had a spook in September when a lot of people thought that the housing market might go, the sort of fear that's always hanging over the miners. Do you track China especially?
Well, you can do that if you want, but that means you've got to believe their statistics, and they're probably sort of roughly aligned with whatever the midline is doing, but manipulated nonetheless. I think you do need to be very aware of what China's doing, but I don't track it religiously. Not to the point where I could say, what are we seeing in the next 6 months out? What's China doing in that time? It's more for me, tracking China is how has their behaviour changed in the last 5 years, and how does that make us feel about their aggression in the next 5 years?
Interesting. Well, I mean, for anyone listening, is there a sector or one that you think is of high could be good value, or really a project by project thing with you, and you're really in the nitty details of the geology, which is sort of specific to your strategy?
Yeah, well, look, the things that I find really interesting about the mining market today are that there is an awful lot of money flowing in, which means that you can say, what are my chances of being involved in a discovery? If you could say your chances are nothing because no one's exploring, then put your money in BHP or Rio. If you need to be in a mining sector thing, because it'll just be the place where it's probably going to experience the least volatility, or even an ETF or something like that. So now's the time when you can invest in exploration. If someone gets good results, they will probably get rewarded for it. And you need to be a judge of whether or not you want to keep your money in there. I mean, this is one of the biggest problems that gets caused in these markets is people put 20 cents in, it turns into 40 cents, and they think they're a genius, and it's going to go to $1. And if it only ever gets to 40 and then goes back to 5, they're always sitting there feeling like they're hooked, but they don't really know why. So I think with that caution in mind, now is an exciting time to be looking at things in the exploration space. You're going to have to double check what a company is worth before you get into it. Just look at the market cap. If all they're doing is exploring and they're capitalized at $300 million, then, second guess yourself. But now is the time you can look at those. I think you need to be careful with the developers. Some of them are going to come out of the other end. There's going to be a rump of ones which are injured, and that is bust or no bust. I think there are going to be some who just fall over here because they're spending the money too quickly on things which are inflating too quickly. And I think you can probably look at the ones which are very close to production now and feel that they will be rewarded by the market in a short period of time if they can deliver their cash flow. And you can probably read through their results and make a judgment for yourself as to how close they are and whether or not they're
just on that. I mean, how efficient do you think the market is when it comes to mining stocks, juniors? I mean, it's one thing to see a good project, and then you go, well, is it priced already? Do you think there are inefficiencies there that a retail guy that's not like you looking at it all the time can exploit or find?
Yeah, I do. And they're usually driven by time. So the biggest, the best projects at the lowest price you're going to find in a market where no one's interested. It's going to be very unusual to find something in an excited market like this where you can say, wonderful project, really poorly priced. Now, when you look at a company, you're not just buying the project, like we said before, you're buying the person as well. And in many, many cases, you might find that if it is a good project and it's been really poorly promoted, that is the problem. But how do you fix that as someone who's got $5,000 to spend? You can't. It's just an avoid. If you're prepared, I mean, they're good M&A targets, those things, but it still doesn't mean that they'll be taken over because, poor promoters are often the first ones to try and protect their jobs as well.
Interesting. All right. Well, let's leave it there. So just to bring it back to the clock where we began. So basically you're saying it's time to be a little bit wary for maybe with a mining crash. There's an expression in the market where bottoms are an event, tops are a process. So would you imagine that we do go into some sort of down phase? Would you expect that to be like, oh, China's economy's just collapsed, or it's like a grinding sort of, oh, it might come back kind of grind down sort of situation? What's the more likely scenario?
The biggest risk at the moment, I think, is inflation. And how does that manifest? It's probably going to have to manifest at some stage with interest rates going up in an official sense. The bond market has already started to creep, but I think there's still, a wavering, what do we do there? So I think interest rates tend to move all at once. They're not going to creep up from virtually 0 to 10% just by a war of, death of 1,000 cuts. To battle inflation, it's going to need to be some big jumps at some stage. And I think that's probably going to be a point where people start to say, oh, we start to believe this now. All of a sudden, the cost of capital changes. So I think that's a risk to be aware of. But, crashes in the equity market can be driven by perception rather than necessarily by events as well. So I think once that realization sets in, that could be the point where the equity market starts to correct. I don't see too many intrinsic risks within the mining sector. I think that for now, that will be that will crash risks. I mean, I think that will be driven by the equity market if it's going to happen. And what we know is that you always have the end of a cycle. So it's not a question of if, it's a question of when.
I assume you have a list of stocks where you're like, if their crash came along, you'd be happy to step in at some point.
Yep, definitely.
Interesting.
And I guess, I mean, from my own perspective in Lion, we've just sold our largest investment. So we're eating our own cooking here and saying now's not a bad time to be exiting things. You can see the liquidity's there because it's coming to us wanting to buy things. And so we will find ourselves within the next 12 months having probably $90 million of cash. So that shopping list could be quite long. And I'd be happy to buy more of them than less, in fact, in the next time round, rather than sitting at 5%. I think we'd be quite happy to buy larger percentages than that.
So in terms of your fund, do you have a mandate how high cash you can go, or?
No. But we have a lot of shareholders that have been with us for a long time, and I think we'd like to see some of that distributed. So the board at the moment is deliberating over what a dividend policy needs to look like. And I think we'll be able to speak more about that probably in the next 2 or 3 weeks, we're aiming to.
Great. All right. Well, we'll leave it there. And definitely, I want to get you back on because this is fascinating stuff. It's such an important part of the Aussie market. So thank you.
It's been great to talk to you about it, Callum, and I really appreciate you inviting me to come along.